Well, good day, all. Ira Epstein with your financial market wrap-up for this Independence Day holiday we're coming into. And today is July 3rd, 2019, just about 3:20 p.m. Central Daylight Time. So I want to wish you all happy Independence Day, great barbecuing, and get back to the market safe and sound. Interesting times that we're in. You know, I was wondering why the gold market exploded yesterday, and what it turns out is that it had nothing to do with the Russian submarine. It had nothing to do, apparently, with Vice President Pence going to an airport, and before he was supposed to go to New Hampshire and speak, they'd had him turn around and go back to the White House. It sounded like there was an emergency. We don't know if there was or wasn't. What we do know is the president did not put up for nomination two candidates. One happens to be a gold advocate. In other words, going back to the gold standard. In other words, don't just keep printing money, make it account for something in some manner. Well, that in part is what I think got the gold market going. As for the stock market, we're hearing that the U.S. and China might be ready to start sitting down for talks, and I'm talking face-to-face as early as next week, according to Larry Kudlow. I keep getting bothered, though, by the fact that no one is saying if those talks are going to be picking up where they left off. Are we in agreement on intellectual property or not? If we're not, Chinese can say they'll buy all the goods they want. They're the ones getting hurt. Dell, Hewlett-Packard. A lot of people are now moving parts of their operations outside of China. They don't want to be caught in this fire anymore. China, on its own, has bought a lot of soybeans from Brazil. I'm reading how much of the crop, almost 80% of it went to them. So they've picked up new supply lines on their own. I don't see this thing ending anytime soon. I'm probably in a minority, but it's what I see. I do see our Fed and other central bankers becoming more aggressive in taking control of the slowdown in the economy, realizing these trade spats may not go away so fast, and taking action. And that has gotten the stock market to a degree going. Because where do you go for yield? And a lot of people are just saying, as this market just keeps moving higher to all-time highs, I'm missing the boat, I got to get in. I'm not saying that's the right thing to do or the wrong thing to do. I'm saying there's dividends there. There's some values, I guess, that people think. And the market has just been in this since December, this move that is unbelievable. You're up nearly, double digits and nearly 20% in some of the indices. You can see how the market keeps running to the upside. Bullish. That's the only word you have for it. It's got the pattern of higher lows, higher highs, bullish. Market's over the 18, the 100, 200-day average of closes. Hasn't even challenged these since June again. And once it flip-flopped at the beginning of June over that 18-day average, it has not looked south again. Where's the resistance? You're at it. You're right at that Bollinger top. That's what often stalls these markets out. That does not mean you can't run that index. Running means you just stay glued to it. You come down, you get back up to it. That often gets accompanied when momentum locks in. Now, the momentum and the slow stochastics now, both numbers are over 80, as you can see. Yesterday, they were not. Day before, they were not. So this is an overbought market that is at a key resistance point in an uptrend. And now the question is, does the market convert from overbought or get another little bump back down? In the NASDAQ, we're reaching up, and again, this market's paying attention to that upper Bollinger Band. The market's, that number, by the way, is 78.97. You're trying to get up to it. You finished today at 78.88 and 78.92. That number. Like the S&P, it's overbought, but you're still in an uptrend into a resistance zone. You're in an uptrend in the Dow. Higher lows, higher highs. Hasn't hit the upper Bollinger Band. That's just over the 27,000 mark. And again, a market that's overbought. The question is, can it convert to being what? Embedded down the road. And in the Russell, I think we were just talking about this 2 days ago. Here's the market over the upper Bollinger Band, falls back to an area, the 100-day average of support. If it drops more, I'd look for the right through here, the 200-day and the 18-day, and if it rallies from here, I'm going to look for the upper Bollinger Band to be resistance. I still am in that school of thought, haven't changed it. What you don't want to see in this index is the market getting under 1554.70. That will break this pattern and potentially bring it back to the 100 of the 200-day average of closes. In the VIX, I had thought that the pros were begun selling puts right through here. I still think they have. If you go back in time, if they've sold that lower Bollinger Band, they've been able to get out either at the 18-day average or the closer of the 100, whichever one's closer. Well, these two averages are about together now, so that would be the objective. But whenever you sell a put or a call, remember, it's like a futures contract. You have risk that keeps moving out. I don't think they're putting on strategies. I think they just went short. In the bond market, right up to the resistance point, just like you did here, the upper Bollinger Band, in an uptrend, bias is up. How do I define bias? I look at the 18-day average is the line in the sand, the delineator. And if you're over it, real simple, I have upside bias. If you're under it, I have bearish bias. I use that as a filter on the swing lines and try to put all that together. So you've hit an upside target in an overbought market, and we'll see what it does from there. What about the 10-year notes? Overbought, upside bias, trend up, higher lows, higher highs, resistance 128.16. What about TLT? Well, it went back to that line in the sand, the 18-day average, made a run yesterday. Now the question is, if it runs today, I'd look for the upper Bollinger Band. That's where the market's at, and I expect to see some resistance here. Can you just break out and make a run? Of course you can. There's no question that you can't. Why? That becomes the thing. As a chartist, you don't look at the name of the chart, you look at the chart pattern, and I'd still say you're in a resistance area. In the dollar index, instead of getting follow-through to the upside, the market's decided to pull back, and it's fighting a battle between the green line, which is the 100-day average, and the 18. What is the trend? Up. Higher lows, higher highs. And today, the market finishes at 96.34, so it's over both the 18 and the 100-day. The trend remains up, the bias up, momentum up. Market's still very much in an uptrend. Eurocurrency's the mirror image the other way. Lower highs, lower lows, under the 18 and the 100-day average, still pointing to the downside. If it were to fall apart, maybe it gets to the lower Bollinger Band. What about rallies? Well, the resistance are these two moving averages on a rally. British pound, you're reaching, trying to get to that lower Bollinger Band. Don't know if it'll hit it, but you're pretty darn close, and you're not yet in oversold territory. Lower highs, lower lows. In the end, instead of any follow-through on these downsides, the market lifted up now, and it got itself today to 93.50 over the last high of 93.49. You negated the downtrend. You're not reaching for this number. I don't know if you're going anywhere to the upside. You seem to be stuck in no man's land. We then get to Bitcoin, which, as I said yesterday, it fell down after it lost an embedded reading, got to the 18-day average, that line in the sand. That's where I think pros, if they were bearish, and I'm not saying there were or weren't, but that's what I'd look for to be the support zone, and you're getting a little follow-through to the upside today with it. Then we get to the energy markets, which confused me. In fact, I got confused yesterday a lot. But the API number to me looked so bullish, I didn't understand why the trade didn't react in a bullish way to it. OPEC agreeing to a 9-month deal that ends in March, where they're going to continue their production cuts. All the unrest with Iran, who's producing the uranium, and we don't know. The good thing is Iran hasn't done anything to get everybody on their back over in the Strait of Hormuz or the Persian Gulf yet, but now we're hearing other stories, and you've got to be a little nervous. Suddenly, you're getting that pop over the 2 days. The spread moved actually before the market did, and you can see that. And what I mean by that is, finally, you're respecting the 18-day average of closes in the SEP Brent. You have nothing here that I'd hang my hat on to be a bull. You've got momentum still down, you have bias up, and you got a higher high, lower low. It's a mess of a chart. When you come to the August WTI crude, Higher high, lower low, momentum pointing down, bias up. I'll stick with what I'm saying. A mess of a chart. Then rebob gasoline. If I had to pick a day that I was confused on yesterday, you lose the embedded reading, you make the lower low. Wow. And the numbers all looked good on everything. So the question is, are you going to make a run for the 100-day average? What's the only time you can gain back the momentum if you lose it on the embedded part of a stochastic? The day after you lose it. Today was the day it had to prove itself. You're up 500 points in the market, almost 3%. So the market proved itself. And in nat gas, well, if you can get up on Friday, up and over this 229.70, you have the makings of a market that's giving you a turn. You could then have higher lows, higher highs over that number. We haven't had an upthrust in this a while, and the market hasn't been able to stay over that 18-day average since back in the middle of May. Now the question is, if you can do that, is that enough with hot weather that's coming in and all to give the market some demand? We saw today that numbers came out from the EIA. They added a bit more in the nat gas stocks than the market wanted, but this is a funny week for it. You can't go by this week. Factories are closed. People get off for the Independence Day holiday. I'm one of the few people left in this building, I can tell you that right now. And tomorrow they're not going to be working, so they don't have the work day on Friday in a lot of factories. They'll come back to work be Monday, so the demand starts picking up more or less normal at that point. Want to remind you about my morning subscriber video. You know, if you like what I do here, you might really enjoy what I do in the morning, because I review 40 charts, 5 ETF charts in addition typically. I'll sit there and give you my idea of buy here, sell there, do whatever, both from a short-term and a longer-term perspective. I'll talk the morning fundamentals, because I try to get these out well before most of the U.S. Reports come out at 7:30 in the morning. I start recording typically at 6 in the morning, and that means I'm up at about 5 reading about what's going on in Asia, what's going on in Europe. I do what's called the daily numbers. I update my charts, then I record this. It's probably worth a look-see. $7.95 for the first 30 days. After that, if you decide to stay with it, $15 every 30 days, or you can buy a 1-year subscription for $156 and just make your life easier. Any way you go about it, it's a lot of value for very little money. How do you get it? Go to our website at www.iraepstein.com. Take a look under education or research, morning subscriber video. It explains it in detail, and away you go if you decide to do it. I hope you do. I hope you have a great 4th of July, and I'll see you all Friday.